Thank you for attending today. My name is Jay Cohen, and I'm a licensed insurance agent with Gibbs Insurance Financial Services located in Ocala, Florida. I appreciate you taking a little time out of your day to be here because life insurance is one of those topics that people know is important, but they do not always get a clear, practical explanation of how the moving parts work. Today, we're going to talk about building cash value for the future. And I want to say right up front, this is meant to be a simple and practical conversation. We're not going to turn this into a technical insurance class. What we are going to talk about is what cash value is and how it can fit into permanent life insurance, what people use it for, and just as important, what you can be careful of before you decide. Most of the time, when people think about life insurance, they think about the death benefit. Simply put, that is the money that will go to your family if something happens to you. This is still the foundation of life insurance. Life insurance should first answer the question, would the people who depend on me financially be okay if I were not here? And if that answer is not clear, then the first job is protection. Cash value adds another layer to the conversation. With certain types of permanent life insurance, part of the policy can build value over time. That value may give you some flexibility down the road. It can be used for future planning, emergencies, retirement income conversations, or simply to provide another financial resource tied to a policy you already own. But it should always be viewed in context alongside your budget, protection needs, and long-term goals. But here's the key point. Cash value is not magic, and it is not free money. It depends on the type of policy, how it's funded, and how long it stays in place, and how it's managed. Two policies can look similar on the surface and behave very differently over time. So our goal today is not to say this is right for everyone. Our goal is to help you ask better questions and feel more confident when you review your options. As we go through this, listen for the trade-offs. There are potential benefits, but there are also costs, rules, loan considerations, surrender charges, and tax issues that may come into play. I'm not here to rush anyone into a product. I am here to give you the framework so that if cash value comes up in conversation, you know what to ask and what to slow down on, and what information you need before moving forward. By the end of our time, I want you to feel more comfortable with the language, more aware of the trade-offs, and more prepared to review whether this kind of planning makes sense for you and your family. And you do not need to memorize every term. If one idea sticks with you, let it be this. The policy should serve your life, your family, and your goals. The product is only useful if it solves a real problem in a way that you understand. Here's the path we're going to take today. I want to give you the roadmap first because cash value can feel like a big topic if we jump straight into policy names, policy loans, tax issues, and illustrations. The goal is to take it one layer at a time. First, we will define cash value in normal, everyday language. You may have heard terms like whole life, universal life, indexed universal life, or permanent insurance. Those labels matter, but they can also distract from the basic idea. So before we start comparing products, we're going to focus on what cash value is meant to represent inside a policy. Second, we will compare term life and permanent life. I like to do this early because there's a lot of confusion that comes from expecting one type of policy to do the job of the other. Term insurance is often used for a specific period of protection. Permanent insurance is designed differently. It may cost more, but it can include features that term insurance does not cover. Third, we will discuss how people may access cash value during their lifetime. This is where we will talk about withdrawals, loans, surrendering a policy, and using the policy's value. We will keep this practical because the real question is not only can I get to the money, the real question is what happens to the policy afterward. Fourth, we will talk about costs, risks, policy loans, and tax watchouts. I'm not a tax advisor, and this is not tax or legal advice. But there are some basic issues everyone should understand before making decisions about cash value. A feature can sound attractive and still deserve a careful look before you rely on it. Finally, we will end with a simple review framework. My hope is that you will walk away with a short list of questions you can use when reviewing your current coverage or comparing options. Those questions can help you slow the conversation down and ensure the policy is built around your real goals. So think of today as a guided conversation. We're not trying to make one decision for everyone in the room. We are trying to make the topic easier to understand so you can recognize when cash value may be helpful, when it may be necessary, and when you may need to see actual numbers before deciding. As we move through the slides, I will point out where a question is something you can think through on your own, and where it's better to sit down and look at a specific illustration or policy review. Some parts of this are conceptual. Other parts, you really need your age, health, budget, family needs, and goals in the conversation. And one more reminder before we move on. If something sounds promising, that is not the finish line. It is the starting point for better questions. A good policy conversation should leave you feeling more clear about the trade-offs, not pressured to make a quick decision. This topic matters because people are trying to do more than just buy a policy. They're trying to make sure their financial plan holds together. Most people buy life insurance because they care about someone. That might be a spouse, a child, a partner, a parent, or even a business. They want to know that if something happened, the people left behind would not immediately have to worry about the mortgage or rent, groceries, car payments, tuition, or final expenses. That protection piece is still the main reason life insurance exists. But as people look further ahead, another question sometimes comes up. Can I build something inside the policy that may help me later? That is where cash value enters the conversation. It can give some policies a living benefit component. In other words, there may be value you can access while you're alive, not only a death benefit paid after. For some people, that is appealing because they like the idea of having a policy that can stay with them for life, while also building a resource they can review over time. Maybe they are thinking about future income. Maybe they're thinking about a backup bucket. Maybe they simply like the idea of having options. But this is also where we have to slow down. Cash value should not be treated like a shortcut or replacement for good basic planning. It does not remove the need for savings. It does not remove the need for budgeting. It does not mean a policy is automatically a good fit. Details matter. The type of policy matters. The premium matters. The guarantees matter. The cost of the insurance, policy fees, and the way cash value is credited all matter. So when I say the topic matters, I do not mean that everyone needs cash value life insurance. I mean people deserve to understand what it is before they either dismiss it too quickly or buy it without asking enough questions. I also think this matters because people are being asked to make a lot of financial decisions. There is retirement planning, emergency savings, college costs, caring for an aging parent, and protecting income. Cash value is not the answer to all of that, but it may be one tool in a broader conversation. The key is knowing where it fits and where it does not. This also matters because people often hear only one side of the story. Someone may hear that cash value is a powerful planning tool, and someone else may hear that it's always too expensive or too complicated. The reality is usually more personal than either extreme. The right answer depends on the need, the budget, the time horizon, and the way the policy is built. Another reason to understand this topic is that life does not stay still. Income changes, family responsibilities change, health changes, and retirement goals change. A policy that includes cash value is usually a long-term commitment, so it should be reviewed in light of real-life circumstances, not just on the day it was purchased. So as we talk today, I want you to hear this as a planning conversation, not a sales conversation. The question is whether cash value sounds interesting. The question is whether it helps solve a real problem for your household in a way you can understand and maintain. Let's explain cash value in simple, practical terms. Cash value is the living benefit part of some permanent life insurance policies. That means, in addition to death benefit, the policy may build a value that can be used or accessed during your lifetime. Now, there's a few important words in that sentence. First, I said some permanent policies. Not every life insurance policy has cash value. Term life insurance generally does not. Term is usually straightforward protection for a set period of time. Second, I said may build. Cash value does not simply appear overnight. It usually takes time. In the early years of a policy, cash value can be limited because part of the premium goes towards policy costs, insurance charges, and contract setup. This is the one reason permanent life insurance is usually better viewed as a long-term decision. Third, the cash value inside the policy, it's not the same thing as a checking or savings account or an investment account. That distinction matters. You cannot always treat it like cash sitting in a bank. There are rules. There may be surrender charges, there may be loan interest, there may be tax consequences depending on what you do. The simplest way to say it is this: protection first, flexibility second. If a policy cannot meet the protection needs, the cash value conversation may miss the point. But if the protection need is being addressed, and the budget allows for a permanent policy, then cash value can become part of a broader planning conversation. It can potentially give you choices later. You may be able to borrow from the policy. You may be able to withdraw a portion of the value. You may be able to use accumulated value to help with premiums, but each of these choices can affect the policy. So, as we go through the rest of this webinar, Keep that simple phrase in mind. Protection first, flexibility second. Here's a quick example. If a family needs $500,000 in protection to help replace income, but the budget only supports a smaller permanent policy, we should not ignore the protection gap just because cash value sounds attractive. We may need to look at term coverage, permanent coverage, or a blend. The protection needs come first. A helpful way to think about cash value is to separate the policy into two conversations. One conversation is about protection. What happens if you die and your family needs that death benefit? The other conversation is about living flexibility. Whether the policy may build value, that gives you options later. Both conversations matter, but they are not the same conversation. That is why I do not want anyone to hear the words cash value and automatically assume it means extra money available right away. In many cases, the early years are about establishing the policy covering its costs. The value may become more meaningful over time, especially when the policy is funded properly and reviewed regularly. When somebody reviews a policy, I like to slow down around this point. If cash value is there to create flexibility, we need to know what kind of flexibility it provides, when it might matter, and what the trade-offs come with using it. That keeps the conversation grounded. This slide is important because much of the frustration with life insurance stems from comparing the wrong things. Term life insurance and permanent life insurance are designed to serve different purposes. Term life is usually the simpler and lower cost option at the beginning. You choose a coverage amount and a term such as 10, 20, or 30 years. If you die during that term and the policy is still active, the death benefit can be paid to your beneficiaries. Term is often used for big temporary needs, like income replacement when children are young, covering a mortgage period, or protecting a spouse during working years. The trade-off is that term life generally does not build cash value. When the term ends, the coverage may end, become more expensive, or require new planning depending on the policy. Permanent life insurance is different. It is designed to stay in place for life. As long as the policy is properly funded and maintained, certain permanent policies can build cash value. That is the part we are talking about today. The trade-off is cost. Permanent coverage usually requires a higher premium commitment than term coverage. That does not make it good or bad by itself. It just means that the policy is trying to do more. It provides death benefit protection and potentially builds value within the contract. So the question is not which one is better. The better question is, what job does the policy need to do? If your main concern is getting the most protection for the lowest current premium, term insurance may be the right choice. If your concerns include lifetime coverage, legacy planning, or long-term flexibility, permanent coverage may be worth considering. Sometimes people use both. They may use term insurance for a large temporary need, and permanent insurance for a smaller lifetime need. That is why a review is helpful. The goal is not to force anyone into anything or any one product. The goal is to match the policy to the purpose. Think of it like tools in a toolbox. A screwdriver is not better than a wrench. It depends on what you're trying to fix. Life insurance works the same way. The right coverage starts with the job. temporary protection, lifetime protection, cash value flexibility, legacy planning, or some combination of these. Here's another way to frame it. Term coverage often helps solve a large temporary protection problem. Permanent coverage may solve a lifetime protection problem or a planning problem where cash value is part of the design. Neither one should be forced into a job it was not designed to do. That is why I like to begin with purpose before discussing premium. A lower premium is helpful only if the policy actually covers the risk you are trying to protect. A more expensive policy may be reasonable only if additional features are useful and affordable. The decision should start with the job, then move to the policy type, and then move to the cost. For many families, the answer is not all term or all permanent. It's not a this or that. It may be a blend or just may change over time. The important thing is to avoid buying a policy just because it has a feature or rejecting a policy before you understand what it may solve. Let's walk through the basic flow for building cash value. Step one is simple. The premium goes in. With a permanent policy, part of that premium helps pay for the life insurance protection. Part may go towards policy expenses and part may contribute to the cash value, depending on the policy design. Step two is for policy charges to be paid. This is one of those pieces people sometimes overlook. A policy has costs. There can be cost of insurance charges, administrative charges, rider charges, and other expenses. These charges affect how much value can be built over time. Step three is to credit the cash value. How that happens depends on the type of permanent policy. In a whole life policy, there may be guaranteed cash value growth and possibly dividends, although dividends are not guaranteed. In a universal life policy, the credit can work differently. In an indexed universal life policy, values may be tied to an index strategy with caps, floors, and other rules. The details matter. Step four is review. This is where I want people to pay attention. A permanent policy is not something you should buy and then put in a drawer for 20 years without ever looking at it. It should be reviewed. Are the premiums being paid as planned? Are the values tracking reasonably? Has your family situation changed? Has your need changed? Step five is that access options may become available. Over time, if the policy has built enough cash value, you may have options. You may be able to borrow. You may be able to withdraw, and you may be able to use policy values in other ways. But again, the key word is maybe. Actual results depend on the carrier, the product, the funding level, the charges, and the guarantees. That is why an illustration is very useful, but they need to be read carefully. This is also why two policies with the same death benefit can behave very differently. The premium, guarantees, riders, crediting method, and policy charges can change the long-term picture. So it is not enough to say, how much insurance am I getting? You also want to ask, how is the policy built? Funding is especially important. If the policy is funded at a bare minimum, the cash value story may look very different from that of a policy designed with stronger funding. That does not mean one design is automatically right and the other is wrong. It means you need to know what the policy is asking to do. I also want to emphasize the word review again. Interest crediting, dividends, policy charges, loans, and premium patterns can all affect the long-term picture. A review does not have to be complicated, but it should answer a few basic questions. Is the policy healthy? Is it still on track? And does it still match the reason you bought it? A policy illustration can help with this, but it should not be treated as a planning tool, not a crystal ball. It can show current assumptions and guaranteed values, but the real value comes from understanding what drives the numbers and what should be reviewed later. Now, let's talk about why people are interested in cash value in the first place. One possible use is emergency flexibility. I want to be careful with using that phrase because life insurance policy should not be your only emergency plan. Regular savings should come first. But if a policy has built enough value, it may give you another option when something unexpected happens. For example, someone may have a major home repair, a medical expense, or a temporary gap in income. Cash value might help, but it should be used carefully. Before taking money from a policy, you want to know the effects of the death benefit, whether loan interest applies, whether the policy can stay healthy afterward. Another possible use is future income planning. Some people like the idea that the policy value may be available later in life. That can be useful in the right situation, but it is not automatic income. It usually involves withdrawals or policy loans, and those choices need to be monitored over time. A third use is premium flexibility. In some policies, accumulated cash value may help support future premiums. That does not mean premiums simply disappear. It means the policy may have enough value to help cover some costs depending on the contract, the funding, and how the policy performs. A fourth use is legacy planning. Some people want coverage that can stay in place beyond a mortgage or child raising period. They may want money to go to a spouse, children, grandchildren, a charity, or to help with final expenses. Permanent life insurance can sometimes fit that goal because it's designed for lifetime coverage. The important thing is that these are different goals. A policy designed mainly for final expenses may not look the same as one designed for potential supplemental income. A policy intended to provide emergency flexibility may need to be funded and reviewed differently from one primarily for legacy planning. The common thread is flexibility. Cash value may give you more choices later. The other common thread is responsibility. If you borrow, withdraw, reduce premiums, or change the policy, there are consequences. That does not mean you should never use the value. It means you should understand the effect before you use it. So when people say, I want a policy that builds cash value, I usually want to ask, what do you want the cash value to do for you? The answer helps shape the rest of the conversation, as the purpose should guide policy design. The timing matters too. A policy that is only a few years old may not have enough value to support the same choices as a policy that has been funded and reviewed for many years. Cash value planning usually rewards patient consistency and realistic expectations. So the main point is simple. Cash value can be helpful, but it needs a purpose. It should support the plan and not distract from the reason the insurance was purchased in the first place. This slide covers what happens when you want to use cash value in a policy. There are a few common ways people may do that. You may take money out. You may take a policy loan. You may cancel the policy and take the surrender value. In some policies, you may also be able to use cash value to help with future premiums. Let's start by taking money out. A withdrawal can lower the cash value and may also lower the death benefit. Depending on the policy, there may be tax issues too. So before you take money out, you want to understand the full effect. A policy loan works differently. You are borrowing against cash value. That can be helpful, but it is not free money. The loan can build interest. If it is not repaid, it usually reduces what your beneficiaries receive. If the loan gets too large, it can put pressure on the policy. Canceling or surrendering the policy is a bigger step. It usually means that the coverage ends. If the policy has a gain, there may be taxable income. This is why it's important to slow down before making that kind of decision. Using cash value to help pay premiums can also sound attractive, but it still needs to be watched. If the policy value is not strong enough, or if the policy performs differently than expected, the coverage may not last as long as someone has hoped. The main idea is simple. Access has consequences. Just because you can use cash value does not mean every choice is harmless. Before using cash value, ask a few basic questions. How will this affect the death benefit? Will interest apply? Could there be taxes? What happens if I do this more than once? And will the policy still be healthy afterwards? This is where an in-force illustration can help. It shows how the policy looks today and how it may behave if you borrow, withdraw, change premiums, or keep everything the same. If you already own a cash value policy, an in-force illustration is one of the best review tools available. It can help you decide whether to keep doing what you're doing, adjust the policy, pay down a loan, or simply keep monitoring it. So the takeaway is this: cash value can give you options, but those options should be used with a plan. You want the policy to keep serving the people and goals it was designed to protect. Now let's talk about the part that's not always as exciting, but extremely important: the costs and trade-offs. Permanent life insurance generally costs more than term insurance, especially in early years. That is because it is designed to provide lifetime coverage and may build cash value. So if somebody is comparing only the monthly premium, permanent coverage can look expensive. But the premium is only part of the story. You also want to understand what is happening inside the policy. What are the policy charges? What riders are included? How much the premium is supporting insurance protection? How much is helping cash value build? What is guaranteed and what is projected? Another trade-off is time. Cash value usually works best when the policy is held long enough and funded consistently enough. If somebody buys a permanent policy and then stops paying early, they may be disappointed with the results. That is not because the concept is bad. It is because the policy may not have enough time or funding to do what it was designed to do. There is also complexity. Some people want very simple coverage. They want death benefit, a premium, and a period of time. There is nothing wrong with that. Permanent policies can require more explanation and more ongoing review. So here's a practical way I would frame it. If cash value is part of the reason you are considering a policy, you need to be comfortable with the premium, the time horizon, and the need for review. This is not something to buy because it sounds interesting. It should fit your budget and your purpose. A policy that is technically well designed but uncomfortable to pay may not be the right policy. The best policy is the one you understand, can maintain, and can review over time. I would rather see someone choose a smaller policy that they can comfortably keep than a larger one that becomes a strain and later dropped. Consistency matters. A policy that stays in force and does its job is usually more valuable than an impressive illustration that never becomes realistic in day-to-day life. One trade-off people sometimes miss is opportunity costs. Money used to fund a permanent policy is money that is not being used somewhere else. That might be perfectly acceptable if the policy is solving the right problem. But it should be intentional. You want to know why those premium dollars belong in this policy rather than being used for other protection, savings, debt reduction, or retirement plan. Another trade-off is flexibility versus discipline. A permanent policy can create long-term structure, which some people appreciate. But that structure also means the premium commitment needs to fit comfortably. If the policy becomes a burden, the plan can break down before the benefits have time to develop. When the cost feels high, the right response is not always yes or no. Sometimes the answer is to adjust the design, lower the death benefit, blend term and permanent coverage, or wait until the budget supports the plan more comfortably. There are three things I want you to be careful with before making a decision about cash value. The first is policy loans. A policy loan can be useful, and for some people, it is the reason they like having cash value. But I want to be very clear, it is still a loan. If you borrow from the policy, interest can build over time. If the loan is not paid back, it usually reduces the death benefit. And if the loan gets too large, it can put a strain on the policy itself. So, I do not want anyone to hear the words and think that is free money. It is access to value inside the policy, but it still needs to be managed. Before taking a loan, you want to know how interest is charged, whether the plan is to pay it back, and what happens if you leave the loan alone for many years. The second thing to watch is taxes. Life insurance can have some helpful tax features, but it does not mean every move is automatically tax-free. Taking money out, canceling a policy, or letting a policy lapse can create tax issues in certain situations. I am not giving tax advice here, and I do not want this to sound more complicated than it needs to be. The simple point is that before you make a major change or withdraw a large amount of money, slow down and consult the right professional. It is much better to check first than to be surprised later. The third thing to watch is the policy illustration. An illustration can be very helpful because it shows how the policy may work over time. But an illustration is not the same thing as a promise unless the number is specifically guaranteed. When you look at an illustration, ask someone to walk you through it. Ask which numbers are guaranteed. Ask which numbers depend on future assumptions. Ask what happens if things do not go as well as projected. Those are fair questions. They are not negative questions. They are responsible questions. If the policy still makes sense after you understand the guarantees, the costs, the loan rules, and the risks, then you can feel more confident about it. If it only looks good when everything goes perfectly, that is a sign to slow down and take another look. The goal here is not to scare anyone away from cash value. The goal is to make sure you understand what you own, what choices you have, and how those choices may affect the policy later. And if you ever feel rushed or embarrassed to ask questions, pause the conversation. These policies can be meaningful, but they are also long-term decisions. You have the right to ask questions. Take your time and make sure the policy makes sense for you, your life, and your family. So the big takeaway on this slide is simple. Loans, taxes, and illustrations all deserve attention. You do not need to memorize every detail. You just need to know when to slow down, ask questions, and review the policy before making a move. So when might a cash value policy actually make sense? It may make sense if you want coverage that lasts for life. If you're looking beyond a temporary need and want protection that does not end after 10, 20, or 30 years, permanent life insurance may be worth a conversation. It may also make sense when the premium fits your budget. The first part is important. A permanent policy is usually not something you want to start if the premium is already stretched. If paying for it creates stress, that is a sign that the design may need to be smaller, simpler, or maybe not permanent coverage at all. It may fit if you like the idea of future flexibility. Some people want the option to have cash value available later. They may not know exactly how they would use it, but they like knowing there may be options down the road. And it may fit when you are willing to review the policy over time. A permanent policy is not something I would want someone to buy and then ignore. Life changes, income changes, family needs change. The policy should be reviewed as those things change. Now, on the other side, be careful if your main need is the lower premium today. If your priority is maximum protection at a lowest cost, term insurance may be a better starting point. Be careful if you're not sure you can keep funding the policy. Cash value policies can be disappointing if they are started and then stopped too early. They usually need time and consistent funding to work as intended. Be careful if you expect it to act like a bank or an investment account. Life insurance has its own purpose. It has costs, rules, and trade-offs. It should be judged as life insurance first. And be careful if you really dislike complexity. Some people want simple coverage, and that's perfectly okay. The right policy should match the person, not just look good on a spreadsheet. That is why I do not like one-size-fits-all answers. A feature that is helpful for one family may be unnecessary for another. Cash value can be useful when it supports a clear goal, but it should not be added just because it sounds more sophisticated. The more clear you are about the goal, the better the conversation becomes. Saying, I want cash value is a start. Saying, I want life protection and I would also like some flexibility if the budget allows, gives us a much better direction. This slide is a simple list of questions you can take with you. If you're reviewing a policy you already own or thinking about a new one, start here. What do I want this policy to do first? Is the main job protection for your family? Is it lifetime coverage? Is it cash value flexibility? Is it legacy planning? Or is it a mix of those things? The answers matter because the purpose should guide the design. A policy built mainly for protection may look different from a policy built for long-term cash value. And both may look different from a policy built for final expenses or legacy planning. Next, ask, how long can I comfortably pay for it? Not in a perfect world, not if everything goes right, I mean realistically. A policy that looks good on paper, does not fit your budget, is not a good plan. Then ask, what is guaranteed and what is projected? This is one of the biggest questions. Do not be shy about asking someone to walk you through the illustration slowly. You should know which numbers are guaranteed and which numbers depend on future assumptions. Then ask, what happens if I borrow, take money out, lower premiums, or cancel? These are real-life questions. People's lives change. You want to understand your options before you need to use them. Another good question is, what could cause the policy to disappoint me? That may sound negative, but it is actually a very helpful question. Maybe the issue would be stopping premiums too soon. Maybe it would be taking loans too aggressively. Maybe it would be relying too much on numbers that are not guaranteed. You can also ask, what should we check each year? You do not need to be an insurance expert, but you should know the basics. Is the death benefit still right? Is the premium still comfortable? Are loans growing? Are values tracking reasonably? Has anything changed in your life that should change the policy conversation? And finally, ask, who else should be part of this conversation? Depending on what you are doing, that could be your spouse, your tax professional, your attorney, your financial advisor, or another person who helps you make financial decisions. If you remember one thing from this slide, let it be this. A good review should make the policy easier to understand. You should leave with greater clarity about what you own, what it can and cannot do, and which decision needs attention. And if you have an older policy, do not assume it is bad just because it's old. Also, do not assume it is perfect just because you've had it for years. Sometimes older policies have value features. Sometimes they need attention. The review is how we find out. As we wrap up, I want to bring us back to the real point of this conversation. The goal is not to own a policy because it sounds impressive. The goal is to build coverage around your actual life. That starts with your protection needs. Who depends on you? What bills would still need to be paid if something happened to you? What would your family need in the first year? And what would they need in the years after that? From there, we can look at the type of coverage. Does term insurance make sense? Does permanent insurance make sense? Would a combination make sense? And if cash value is part of the conversation, how much premium can you afford comfortably to commit for a long term? Then we look at the details. What is guaranteed? What is projected? What are the costs? What happens if you borrow? What happens if you take money out? What happens if you need to adjust the plan later? This is where personal review can really help. Everyone's family, budget, health, and goals are different. A policy that makes sense for one household may not make sense for another. That is why the conversation has to be personal. A good next step does not have to be complicated. It can be as simple as gathering your current policy, looking at the coverage amount, checking the premium, reviewing any cash value or loan balance, and asking, does this still fit my life today? Sometimes that review confirms you are in good shape. Sometimes it shows a gap. Sometimes it shows a policy that needs adjustment. Either way, clarity is useful. If you're considering a new policy, we would start the same way. We start with the need, not the product. Then we compare options, look at the trade-offs, and make sure the premium is something you can realistically maintain. If you would like to review your current coverage or talk through whether cash value life insurance belongs in your plan, I would be happy to help you look at it. Again, my name is Jay Cohen with Gibbs Insurance and Financial Services, and we are located in Ocala, Florida. You can reach me at 352-661-7858 or by email at jay@gibbsinsuranceocala.com. Thank you for spending this time with me. I hope this made cash value feel easier to understand and discuss. If this raised questions for you, that's a good thing. The purpose of a webinar like this is not to answer every personal planning question in one sitting. It is to help you know what to look at next. From there, we can review your situation step by step and keep the conversation clear, practical, and focused on what actually matters to you and your family.